If you are over 60 and you still maintain money in a standard checking or savings account, there is something you need to understand clearly. The specific words you speak at a teller window have the capacity to shift a completely ordinary transaction out of the routine processing queue and into an automated compliance review. And the most consequential part of this is the part your financial institution will never voluntarily explain to you. Certain sentences spoken in an entirely normal, well-intentioned way are sufficient to initiate an automated compliance review on your account, sometimes before any human being has examined your case at all. You do not need to be doing anything unlawful for this to occur. You do not need to be concealing funds, evading taxes, or violating any regulation. The compliance system does not have access to your personal history. It does not know that you are a retired educator, a widow, or someone who has maintained a spotless banking record for 4 decades. The system processes patterns, and the patterns it is programmed to detect are phrases that people speak every single day in banks across the country without any awareness of what those words set in motion. This is not a situation confined to one institution or one region. Every federally insured financial institution in the United States operates some version of the same compliance software, constructed according to the same federal regulatory framework, monitoring for the same categories of language and behavior. A small credit union serving a rural community of 2,000 people runs functionally identical compliance triggers to a national bank operating branches across all 50 states. Retirement Watch USA covers the financial and regulatory information that affects seniors directly, the rules no one at your bank will explain before they become relevant to your situation. Subscribe now so you are prepared before these situations arise, not after. What follows covers 3 things: the 3 specific categories of language that move an ordinary transaction onto a compliance radar, the reason retirees encounter this problem more frequently than any other age group, and the 5 practices that careful retirees follow before any significant transaction to ensure their funds remain exactly where they belong. None of this requires legal representation, a specialized account type, or any complicated arrangement. It requires understanding the rules that no one distributes at the teller window. The first phrase category, any language that references the $10,000 reporting threshold. This includes sentences such as, "I want to avoid the extra paperwork. Can we keep it under the limit? Is there a way to handle this so it doesn't get reported?" Even a casual remark like, "I'll just come back tomorrow for the remainder," said about a deposit, falls into the same category. Even stating this in a lighthearted tone with a teller you have known for years does not reduce the compliance risk of saying it. The regulatory structure underneath this is as follows. Under the Bank Secrecy Act of 1970, every financial institution in the United States is required to file a currency transaction report with the Financial Crimes Enforcement Network, FinCEN, whenever a cash transaction exceeds $10,000 in a single business day. That report contains your full legal name, social security number, address, and the precise amount and time of the transaction. It enters a federal database accessible to multiple agencies. The report itself is routine. Millions are filed annually for entirely ordinary transactions, and most banks will confirm it is a regulatory requirement because it is not treated as confidential. One figure worth understanding, the $10,000 threshold was established in 1970 and has never been adjusted for inflation. Using a consumer price index calculation, $10,000 in 1970 is equivalent to approximately $75,000 to $80,000 today. This is part of why a standard retirement-related transaction can appear on paper to fall within the range. The rule was originally written to address. The report that is kept confidential is a separate instrument called a suspicious activity report. It carries no minimum dollar threshold. A suspicious activity report can be filed on a transaction of $500, and under federal law, the bank is legally prohibited from informing you that one has been filed. You will never receive notice of it. Any language that frames a transaction around the $10,000 number creates the risk of being interpreted as structuring, a separate federal offense defined under Title 31, United States Code, Section 5324. Structuring is a crime even when every dollar involved is entirely legitimate. A legal history point that matters here. In 1994, the Supreme Court ruled in Withdrawals versus United States that federal prosecutors were required to demonstrate the defendant knew structuring itself was illegal, not merely that they knew about the reporting requirement. That protection did not survive the year. Congress amended the statute specifically to eliminate that element of proof. Under current law, prosecutors are only required to demonstrate that you intended to avoid the report, nothing more. This is not theoretical. In 2013, the IRS seized nearly $33,000 from Carol Hunders, a 67-year-old Iowa restaurant owner, based solely on the fact that her routine cash deposits consistently fell below $10,000. That same year, convenience store owner Lyndon McClellan had his entire business account, $107,702, were seized on the same basis. Both individuals ultimately recovered their funds, but only after years of legal effort, because under civil asset forfeiture rules, the government can seize the money first, and the account holder must then demonstrate their own innocence without any criminal charge being filed. Congress did respond. A 2019 law now requires the IRS to connect any structuring seizure it retains to an actual illegal source of funds. That represents genuine progress. It does not prevent the seizure from occurring in the first place. The practical solution is direct. Never frame your own transaction around the threshold in any conversation at the bank, in person, or by telephone. The second phrase category, language that matches known fraud and exploitation patterns even when no fraud is involved. This includes sentences such as, "My grandson is in trouble and needs this wired immediately. I met someone online and he needs assistance getting home. A contact told me about a guaranteed return in cryptocurrency. Someone from the IRS is helping me move my money to a safer location. Representatives from a technology company are helping me transfer my account somewhere more secure." The same review is triggered by a phone call to your bank using this language as by saying it in person at a branch. The legal mechanism here is the Senior Safe Act, passed by Congress in 2018. That legislation grants trained bank employees legal immunity when they report suspected financial exploitation of a customer age 65 or older. The law does not require the bank to file a report. It removes the institution's legal exposure for filing one. The practical effect is that many financial institutions now train staff to flag precisely this category of language on contact. The volume of resulting reports reflects how seriously institutions have responded to that incentive. In 2021 alone, financial institutions filed more than 72,000 suspicious activity reports connected to suspected elder financial exploitation, an increase from 62,000 the prior year, according to FinCEN's published data. The reports do not exclusively capture actual fraud. They also capture a retiree selling a vehicle to a buyer found through an online listing. They capture someone wiring bail funds to a grandchild. They capture a senior moving savings into cryptocurrency through a fully licensed and regulated exchange. None of those transactions is illegal. The words used to describe them happen to align with the pattern the compliance system is built to escalate. The solution is not to avoid explaining the transaction. It is to substitute the specific trigger language with plain descriptive terms. Online becomes a private purchase. Cryptocurrency becomes a personal investment. My grandson is in trouble becomes a family gift. The transaction itself is unchanged. Only the language describing it is adjusted. The third phrase category, declining to answer a routine question from a teller. This includes responses such as, "That's none of your business. I don't have to explain what I do with my own money." Both statements are factually accurate. It is your money. But under the Bank Secrecy Act's Know Your Customer provisions, financial institutions are required to be able to account for unusual activity in a customer's file. A flat refusal to respond is frequently recorded as the flag itself, not because any wrongdoing has occurred, but because an unexplained transaction is precisely the category the compliance system is designed to escalate. Consider two retirees each withdrawing $9,000 for a home repair. The first says a home repair and completes the transaction in 30 seconds. The second says that's between me and my contractor and receives a call from the bank's fraud department later that day for an identical and entirely legal withdrawal. Years of loyalty to a branch, a long-standing relationship with individual staff members, a history of responsible account management. None of those factors enter the compliance calculation. The system reads the interaction, not the history. Now here are the 5 practices that careful retirees follow before any significant transaction. The first practice is preparing one brief, accurate sentence in advance for any large deposit or withdrawal. Personal expenses, a home repair, a family gift. Nothing referencing the reporting threshold. Nothing framed around avoidance of paperwork. That sentence is decided before leaving the house, not composed at the counter under the pressure of a waiting line. The second practice is allowing a transaction above $10,000 to proceed as a transaction above $10,000. The currency transaction report that follows is standard regulatory documentation. Signing the required form without comment is the appropriate response. Treating the report as something to avoid or work around is what converts a routine transaction into a compliance concern. The third practice is replacing the specific language patterns that trigger suspicious activity reports with plain descriptive alternatives before those words are spoken. Online, in place of phrases that suggest an unfamiliar contact. A personal investment in place of specific asset categories that match known fraud scripts. A family gift in place of language that describes urgency or distress. The underlying transaction is identical. The compliance risk attached to the language is not. The fourth practice is answering routine questions from bank staff, regardless of how unnecessary those questions feel. One accurate sentence closes the interaction. A flat refusal opens a review. If the questions being asked appear excessive or inappropriate, the correct response is to request a conversation with the branch manager. That is a standard and unremarkable request, and it does not carry the same compliance implication as a refusal to respond at all. The fifth practice is assembling documentation before entering the bank. A bill of sale, a written gift letter, an estate document. Having the source of the funds on paper at the moment a question arises eliminates the ambiguity the compliance system is designed to flag. For planned transactions of significant size, a legal settlement, and inheritance distribution, contacting the bank in advance removes the element of surprise that initiates most compliance reviews in the first place. If a pattern in your recent account activity might attract scrutiny, a licensed enrolled agent or tax attorney can review it with you before you proceed. Here's the principle that connects all three phrase categories. None of this involves concealing anything. It is about recognizing that an automated compliance system processes the words associated with your transaction for pattern recognition, not for intent. A small number of entirely ordinary, well-meaning sentences happen to align with the patterns that system is trained to escalate. The appropriate response is not secrecy, and it is not excessive explanation. It is one plain sentence that accurately describes a legal transaction without mapping to any category the system monitors. You are not being asked to be dishonest or to be cold with a bank employee performing a routine function. You are being asked to describe your own legal transaction in the same straightforward language you would use with a neighbor. There is a clear difference between answering a question and constructing an explanation. Bank staff are trained to recognize that difference. The case of Andrew Clyde, a Georgia business owner, illustrates what is at stake when that difference is not understood. In 2013, the IRS seized nearly $950,000 from his business account based on a structuring pattern identified by compliance software. Clyde had not committed any crime. His deposits matched the pattern the system was built to detect. Recovering his funds required years of legal proceedings, a partial settlement in which he forfeited $50,000 to secure the return of the remainder, and ultimately, a piece of federal legislation associated with his case, before Congress addressed even the narrowest aspect of the underlying rule. His situation stands as a direct illustration of the fact that good intentions and an established record of honest financial conduct provide no protection once a transaction pattern matches what the compliance software is programmed to flag. The only person positioned to ensure that your language at your own bank is accurate, plain, and clear of known compliance triggers is you. Doing that correctly is far more straightforward than anything described in this video. Like this video and subscribe to Retirement Watch USA so you receive this category of financial and regulatory information before it affects your accounts rather than after. Share this with anyone in your life who manages their own banking and has never been told what a currency transaction report is or what a suspicious activity report can do. That single conversation may protect everything they spent a lifetime earning.